Howdy, Jacob here. Today we're looking at Expedia Group in the hotel, restaurants, and leisure industry. 24.4 billion market cap, slightly higher enterprise value, 24.7 billion. They operate as an online travel company globally. They do business to consumer, business to business, Trivago segments. Founded in 1996, headquartered in Seattle. Very good revenue growth, over doubling of the last 10 years. COVID absolutely destroyed their revenue, but they are already at higher than pre-COVID levels. Very impressive. And also their gross margin and operating margin are higher than they were at pre-COVID levels, which is very impressive. Earnings per share is again much higher than it was. They cut their dividend out, which we'll see whether we think that that was a good decision or not. Return on invested capital, surprisingly not so grand. Let's look at that income statement, see if there's any R&D. A good amount of R&D. Okay, over 10% of their revenue or as expenses is R&D, which takes money away from today to hopefully get more in the future, make the company more efficient. Very positive. Obviously, we don't know that every dollar is going to be efficient and make the company more money into the future, but that makes us confident that margins would be higher, obviously, if they weren't to do R&D. But if they are efficient at what they do, great management, great R&D engineers and such, they will likely get a great return on that investment. $4 billion in cash and $6.2 billion long-term debt. Their cash flow statement shows great production of free cash flow. Again, outside of COVID, you're looking at a great production of free cash flow, with CapEx still being fairly significant, but nowhere near as much as their production of cash from operations. And the use of cash, at least recently, has been immense amount of share repurchases. So much so that it's almost 100%. And so if we assume maybe 50 to 75% of stock-based compensation, or 50% to 75% of free cash flow production, capital allocation goes towards share repurchases, that would mean that you're looking at about 2 billion, a little bit less, 1.5 billion for share repurchases, offsetted by stock-based compensation, which is still not even 1%. Oh wait, that's definitely more than 1%. Okay, so 240 million is 1%. And we're saying that it would be about 1.5. Okay, so that could easily be about 5% share repurchases. That's pretty impressive. Yeah, I guess we're seeing 7%, 11%. So for 50 to 75% of capital allocation going to share repurchases, net of stock-based compensation, that's about 5% going to share repurchases. If we say the rest goes to acquisition, maybe debt pay down, reinvestment, I think that I wouldn't be surprised if the business were to grow at 7% rates of return. With margins, I like the free cash flow is a little bit higher. So maybe let's go 10 and 15%. Let's do, their return on invested capital wasn't grand. But with this type of growth, kind of solid margins, but a lot of money going to R&D as well. Maybe a 17p in price free cash flow makes sense. And based on this, this is saying that they can hold 15% margin. Their earnings has not been anywhere near that. So their free cash flows is more so the lifeblood of the business in my perspective. But again, if they get cheap enough from a free cash flow perspective, they can buy back this 11% of shares. And even if the business weren't to grow and you were to buy back 11% of shares, in all else equal, you're making 11% return on your money. And so, this could be a good investment at this price. This is going to be something I do a deeper dive on, see whether I feel like 7% growth rate is possible. Holding these type of margins, is that possible? But yeah, hopefully not too much longer until I do a in-depth analysis on Expedia, because it does look like a pretty good business. The only thing I'm against is, again, this low return on invested capital is kind of interesting to me. But anyways, hope you enjoyed this video. Have a great rest of your day.